First of all, I would like to thank everybody who has joined us in this consultation session. And as already we discussed, that this is also mentioned that I'm going to touch upon some of the concepts in IFRS S1 and S2. And I'll be giving highlights of the disclosure requirements contained therein. Yes. So the key concept, behind the introduction of these standards is the previously IFRS accounting standards were providing information about the past transactions. The balance sheet profit and loss account provided information on the past. But these sustainability standards, require the disclosure of the information that is going to impact the company's future prospects over the short term, medium term, and the long term. So why this information is important? Because this information is important in order to help the users of the primary users of the information to make the decisions as to providing the resources to the entity. So the entities. So this is why these standards have been brought in. So the entity's ability to generate the cash flows depends upon its interactions with the resources, with the entity, with the stakeholders such as government, such as economy, environment, and the resources that it has. So this is the interactions over the entire value chain. Yes. So the value chain that the entity interacts with the environment, suppliers, society, customers, and the outputs are generated. Those are products, services, carbon emissions, cash flows, profits, cost of capital, etc. So from there emanates the risks and the opportunities. On the future horizon, let's say short term, medium term, and long term, and that impact on the future cash flows and the cost of capital and access to finance. So this is why because these risks and opportunities impact the future of an entity. So this is why these standards, require disclosures. So IFRS S1 requires entity to disclose, information on all sustainability-related risks and opportunities that are expected to affect the entity's, future cash flows, access to finance, and cost of capital over short-term, medium-term, or long term. So these are the four areas of operations of an entity: governance, strategy, risk management, metrics, and targets. So the disclosure requirements require us that we talk about governance, strategy, as to the management of sustainability-related resource risk and opportunities, governance process that the entity has followed, for monitoring and managing sustainability-related risk and opportunities, the risk management process the entity has installed in its processes in relation to sustainability-related risk and opportunities, metrics and targets which an entity is using in order to monitor the progress and regarding the key indicators, key metrics, key areas of the sustainability-related risk and opportunities, whether those are required as a result of the operations or required by law or regulation. So some of the disclosure requirements are highlighted over here. The materiality concept is same, as regards IFRS 1, S1, and S2, which was there in the IFRS accounting standards. So we need to determine the materiality in the same manner as we determine the materiality for the in relation to IFRS accounting standards. Material information is required to be disclosed, and the information is required to be disclosed when it is immaterial, when it is required by regulation or law. As regards disclosure topics, climate-related topics are required to be disclosed in the first year of application. These standards require us not to disclose other topics. In the first year, only climate-related disclosures are required. From the second year, relevant industry-related topics, disclosure topics can be included in the reporting. Disclosures are required on the core areas: governance, strategy, process, strategy, risk management, and metrics and targets in relation to sustainability-related risk and opportunities. Comparative information in the first year of reporting, no comparatives are required, and comparatives are required in respect of the preceding period, in the future, and descriptive comparatives are also allowed in order to explain the information. There are requirements in relation to connection of the information presented in the sustainability reports and the information presented in the financial statements. There has to be consistency within the information, items of information presented in the sustainability report. There has to be consistency with respect to information presented as part of governance, strategy, risk management, metrics and target, and there has to be consistency as regard information presented in the sustainability report and the financial statements. Timing and location, the sustainability reports are to be presented in the same, may be presented in the same location where the financial statements are presented, may be presented in the annual report. Either can be part of a management commentary or can be, put in as a separate report, appropriately titled as information on the sustainability. There is one more requirement as to the identification of the standards and the guidance which company has applied in the preparation of the sustainability report. The IFRS S1 provides guidance as to how to identify risk, sustainability related risk and opportunities. The standard requires that we have to see what are the requirements as per the relevant sustainability disclosure standard. Then if that guidance is not provided in the IFRS sustainability disclosure standard, then we are required to refer to and consider the applicability of disclosure topics contained in the SASB standards. So these two requirements are mandatory. Besides that, we may refer to other frameworks. We may also refer to the reports prepared by other entities in the same industry or geographical region. How to identify material information matrix about sustainability related risks and opportunities. The standard provides guidance, sources of guidance that we may apply. We are required to apply a specific IFRS disclosure standard that applies to a particular risk or opportunity. In the absence of a specific IFRS disclosure standard, we are required to refer to the SASB standards for particular metrics which relate to a particular industry. Then we may also refer to CDSB framework. We may also refer to the pronouncements by other bodies. We may also refer to the metrics disclosed by other entities which operate in the same industry or region. The second standard is IFRS S2, which relates to climate-related risk and opportunities. It talks about exposure to climate-related risk, plan to mitigate risk, and the opportunities that arise from the climate changes. Some of the key concepts in relation to climate changes are transitional risks and the physical risks and the opportunities. So transitional risks are those risks which arise from transitioning to carbon-free economy or carbon-less economy. So there may be changes in the policy or the regulations which arise the risk. There may be change in the product development or technology which may also raise the risk. So these are the transitional risks. As regards physical risks, climate risks, so these arise from physical events such as cyclone or flood, and there may be chronic physical risks such as rise in the temperatures over time. And there may be opportunities, as a result of managing these climate changes, entities can identify the opportunities for resource efficiencies, energy sources, products and services. There may be, changes brought in the development of the products, and this may, provide savings to the entities. So core content, these are the core elements of operations of an entity. These are to be discussed, as part of disclosure requirements. These are required to be disclosed in the reports as to what is the governance process to manage the climate-related risks and opportunities. What are the strategies that the company has followed to manage climate-related risks and opportunities, and the risk management process that the company has installed in relation to climate-related risks and opportunities, and the metrics and targets the company has set to monitor the progress towards these areas. So this is a chart, that describes as to how this process goes on. I mean, the overall governance process, and there are risks and opportunities, arising from the transitional risk and the physical risk, and there are opportunities arising as a result, because the company is interacting, the company is taking steps in relation to climate changes, and then there arise, opportunities, and that become part of, strategic planning and the risk management process. And yes, this has the financial impact, and this goes on, and this falls into our balance sheet, profit loss account, cash flow statement. So this is a very useful picture to understand as to how this will go. So the important concept in IFRS S2 is climate resilience, on which there are disclosure requirements. Climate resilience is an entity's ability to manage the climate-related risks and opportunities. The entity's ability to adapt itself, in relation to transitional risk and the climate-related physical risk. And there are requirements as to how the entity has got resilience, strategic resilience, and operational resilience in relation to climate-related changes. The disclosure requirements also require us to perform scenario analysis, what-if analysis. If, for example, a physical risk, matures, a flood arises. So how it's going to impact our entity, how it's going to impact the overall, the operations of an entity. So we need to determine as to how it's going to impact us, our value chain, and then we have to disclose it in the sustainability report. So this is a pictorial example of, what factors one can consider. For example, rise in the temperatures, or the physical hazards, or the transition hazards, and it may impact our, risk assessment and our supply chain operations and assets. And this can impact the overall, our company, sector, and the country. So these are highlights of the disclosure requirements which are required as per IFRS S2. So information is required on the governance process, on the strategy part, on the risk management part, and on the metrics and targets. Information is required on whether the company has performed scenario analysis and on the related risk and opportunities. And the information is required on the impact assessment as to how the entity has considered the overall risk and considered its impact on the entity's business, entity strategy and the business model. Climate resilience as to how much the company is climate resilient as regards climate changes, entities, resilience of the entity strategy and the business model to climate changes. And there are most importantly requirements for the disclosures on the greenhouse gas emissions, scope 1, scope 2, scope 3. And this is going to be a very challenging task for the entities I'm going to discuss in the next slide. So scope 1 emissions are those which arise directly from the company's operations. Scope 2 emissions are those which arise as a result of by the other companies, by the other entities which provide energy, lights, for example, electricity to the company. So as a result of our using the energy, the emissions arise. And scope 3 emissions are those which arise at places of other parties, and which arise directly as a result of our interactions with those entities. So the standard requires us, provides relief in the first year of application from disclosing scope 3 green gas emissions. And the challenge is the entities are required to engage with the stakeholders across its value chain to ensure that there are proper systems and controls in place in order to generate the information which are required to be disclosed and to achieve Scope 3 emission targets in future. Now I'm going to present a draft of the sustainability-related information, financial information, which may be used by the companies, and we developed considering the requirements in the standard and the SASB standard. So as part of the requirements, we are required to disclose climate-related risk and opportunities. So within that, these are the disclosure topics, and with the disclosure topics, there are associated metrics. So SASB standards provide guidance for around 77 industries, as to what disclosure topics can be, and the related metrics associated with those disclosure topics. So this is how the overall, information can be presented. Statement of this is a illustrative sustainability statement of sustainability risk and opportunities, showing the climate-related changes for a household company, for a household products company, and this is statement of showing risk and opportunities for other than considering topics other than climate-related. So these are the notes which will become part of the overall statement. So as I discussed earlier, there is a requirement to state as to what standards company has followed in preparation of the sustainability related financial information. So there has to be a statement of compliance showing this. There are requirements for disclosures on governance, strategy, risk management, metrics and targets. There can be commentaries on the regulatory risk as to how, what are the risks and how those risks are being managed, market risks, physical environmental risks, innovative products and service opportunities, and the resource efficiencies and the market opportunities. There are requirements as to the impact over the future, over the short term, medium term, and long term. So this is how information can be presented. And there are requirements as regards climate-related metrics and targets, and which company can respond to in this manner. Now I'm going to discuss proposed criteria for applicability for companies. So the criteria has been developed using a phased approach. So this approach we have considered, we have debated, and we have discussed, and we have while developing this criteria, we have considered the size of the companies. So in the first phase, the companies which are very significant large size companies having turnover greater than 25 billion for the last 22 consecutive financial years can be brought into the applicability criteria. And the companies which have employees greater than 1,000 number and total assets greater than 12.5 billion. So the application can be made from 1st January 2024. It means that they will be presenting their reports somewhere in 2025. So as mentioned earlier, see in the first reporting there is a leeway, there is a room for first reporting to be made within 9 months from the reporting date. Phase 2, within the phase 2, the companies which have turnover greater than 12.5 billion means lower than 25 billion, and the employees they have employees between 500 to 1,000, and the total assets greater than 6.25 billion but less than 12.5 billion they can be brought in to the applicability net, and they are required to report on the sustainability with effect from, let's say, reporting period ended on December 31, 2025. So after that, in the third phase, what we have proposed is In the third phase, what we have proposed is the listed companies which are not falling within this criteria are required to follow these standards. So the So in the third phase, which is for the periods beginning on or after January 1, 2025, the companies, listed companies which have not been into the phase 1 and phase 2 shall be brought into the applicability net. And the first reporting, as I said, can be made within 9 months from the close of the financial year. In the first reporting, only disclosures with respect to climate-related disclosures are required, and climate-related disclosure scope 3 emissions are required, not required in the first year, but in the second year. And what we are proposing is the insurance reporting on the sustainability reports, can be made from the second year of reporting, not from the first year, but from the second year, so as to give room to the companies to prepare, have proper systems in place, proper information in place, generated from the systems, so that it can be auditable, it can be verified, so that the insurance report can be made.